Hey Adam, it's great to have you on the show.
Cool. Hi, Andy. Thanks for having me.
So I'm going to set the scene here. I am really looking forward to this episode because you posted recently about I suppose, the finalization of your exit from your business. I really want to talk about that. I think it's really interesting. But 3 years ago, that's when we met. You came to me. We did a bit of work together, and that was when you embarked on the process of actually exiting the business that you'd founded and scaled up. And seeing you post just the other day about finalizing that exit seemed like a really nice end to the first chapter for you. And watching what you've done during that period, gradually transitioning out of your business, building up your property business, and other stuff that you've done on the way. We've done a bit of work together on the roadmap. In fact, you're obviously the brains behind the deal stacker and the roadmap. You now work with JP, my non-exec. I introduced you to him, and you guys are doing something really exciting. So it's been really, really cool seeing what you've done in the last 3 years. And I feel quite privileged to have been quite intricately involved and being able to see how you did that and how that unfolded, good and bad. And we're going to talk about some of that today, aren't we? But for our listeners of the show, Adam, who maybe aren't aware of you yet, or maybe do but don't know kind of exactly what you're up to, could you give us a bit of an intro about yourself and what you're currently doing, I suppose, in the property space?
Yeah, sure. I founded Highline Property in 2018. We started off with a couple of buy-to-lets. And it was around that time that obviously we worked together with the fast track. So did some mentoring, joined the mastermind. And since then, we've been steadily growing a portfolio of properties. At the moment, we've got three active projects on the go, and that's two HMOs, one serviced accommodation. We've got another one in conveyancing. And our strategy is very much buy at a really good price, so we make our money when we buy. Find something we can add a lot of value to. We then raise angel investment. We add that value via a kind of a heavy refurb, and then we refinance, pay the angel investment back, and then hold them for the long term. So that's what we've been doing over the last couple of years, reasonably successfully. We've secured quite a lot of properties now at really, really good prices, just due to some good due diligence and negotiation.
Yeah, and it's interesting because I think the last 3 years we've definitely been in the market, or in a market where we're all saying, prices are just going bonkers, it's offers over, and it's very difficult to find what certainly feels like a good deal on the way in. But actually, we're going to talk about your case study today that's going to be inside the roadmap, and this is the first HMO that you bought. I remember it very, very well, and I remember the process that you were going through and that you went through to secure that first property. And I actually remember how patient you were in looking at other projects as well. And so many of them just didn't work. So many of them didn't give you the numbers that you needed to be able to recycle the cash out at the back end that you needed as part of your plan to grow. So I'm really interested to talk about your approach there and that whole due diligence piece. And I think that's really exciting as well because you helped build the deal stacker and then you went and built Property Gambit. And so that whole due diligence and deal stacking thing has become a real speciality of yours. But what I want to do is I want to rewind a little bit. Actually, I want to go back to when we first met, because I think that your story is really interesting. I think really inspirational for a lot of people, and I think there'll be loads of relevant stuff here in your story that a lot of people can take from it. So, you had your own business, didn't you, Adam? Do you want to tell us a little bit about that business, what it looked like, and sort of because this was a pretty serious business.
Yeah. We spoke earlier about the entrepreneur's curse. You never feel like you're doing enough.
Yeah.
Well, we founded the business in 2007. There were three of us. Before that, I'd founded another business and exited that successfully. And this was a digital marketing agency. So we were servicing clients like The Economist. We'd worked with BMW, Red Bull. So we've got some really big kind of brand names. In 2000, I think it must be in 2017, 2018, when we were, I guess, at our peak, we had like a 1.8 million pound turnover and 30 staff. But that type of business it's a lifestyle business. It's really difficult to maintain. It's very stressful. They've got very low multipliers on exit. And I found that I was just basically working a full-time job. There were some benefits, but in reality, the amount of time I was trading off in exchange for that didn't really stack up for me. We just had our first child as well, so really started to evaluate kind of work-life balance, and it's lovely, growing a business and being at that sort of scale, but it is very demanding. And for me, it just started to kind of lose its shine a bit, and I really wanted to have more time, more freedom. And not only that, in order for me personally, to look at growing my wealth long term, a business like that with those multipliers is never gonna get me there. Most agencies are valued at, I don't know, between 3 and 5 times net adjusted profit, which means the only way to scale it is to chuck more people at it, and the more people you chuck at it, the more challenges you
The
have.
more stressful it is.
So that's the background. I mean, it was really enjoyable. I loved the experience of growing that business out. And it's taught me a lot of transferable skills into the property market and what I'm doing now. And it definitely feels a bit bizarre coming back a big step and being solo, but it certainly put me in good standing for what we're doing moving forwards.
I mean, on paper, well, not just on paper, very few people could say that they built a company of that sort of size by the age that you did it. And now obviously you've just finalised your exit. That in itself is a huge achievement. And I remember that, and I remember being quite inspired by you at that time. You had far more staff than I did, and in many ways a much more successful business. But you said it yourself, the shine had worn off, and I remember talking to you about that, and you'd sort of lost the passion for it. But you were also really sort of candid and really honest with yourself, I think, about that very fact, which was, this business, as good as it is, isn't actually going to fulfill what you and your family wanted to do, on a very personal level. And so it was. I remember for you, it was such a big decision, thinking about how to exit, and I suppose it was a huge sacrifice for you, wasn't it? Actually embarking on the transition, the process of transitioning from owning a business like that into a new business that was asset backed, like property, that required a lot of capital, a lot, in many ways a lot more risk. You had to make sacrifices, obviously, with your salary and things like that. Talk us through that decision and just how difficult it was, and then, if you're able to, I'm sure there's lots of sensitivities, but how you actually managed that exit out of your business and gradually into property.
Yeah, sure. Yeah, I mean, as you said, it's very difficult. I think when you're, not to say that it's any more difficult than anyone leaving a full-time role, but when you're leaving a full-time role, you've always got the train of thought, well, I was employed, I can go back to being employed. When you're selling a business you've spent 14 years growing, that's worth as much as it is, obviously the end valuation and what I ended up walking away with is a completely different thing, because when you're selling a minority stake of a low multiplier business in the middle of Brexit and COVID, inevitably, what you walk away with is nowhere near what you'd hoped it would be 5 or 6 years prior to that. But yeah, it was a really big decision to step away. Certainly carried a lot of risk, but to date, my track record, I've always taken what other people deem as very risky moves, but I've always seen them as being quite calculated and measured. So for me, yes, it was a big, more of an emotional risk, really, is stepping away from something that I'd spent time growing into something that was very uncertain. But, when you look at it objectively, yeah, it was never going to get me to where I wanted to be. And the only way that business would ever get me more cash flow and more wealth was to chuck more time and people at it, which is going to increase the workload and stress. And although you can systemize businesses, it's still, you're at the mercy of clients. It's very much project driven. If a client drops you, you've got to find a new one pretty quickly. Unlike property, which is asset backed, and as you said, there's a lot of front loading in property, which is probably one thing that I'd overlooked, and I think everyone does.
Do you mean just the sheer volume of capital that you need to get into the game? Yeah.
Yeah, and time. So when you obviously said about discussing that transition out, for me personally, looking at our personal wealth and thinking about the income we'd got, all of a sudden, that income was going to stop. We needed to look at how quickly we can replace the income with property. And when you start looking at, even with a good wind, a heavy refurb is still going to take 4 months. People may do it in less, but everyone I know, typically you're looking at 4 to 6 month turnaround. So you're looking at front loading it with money, time, energy, effort, headspace, at least 6 months before you get any cash flow. And then you need to refinance it, which may take another 1 or 2. So all in, our first project was probably 9 months start to finish before we had any benefit. And then when you start building momentum and stacking that, we're now 2 years in, we're probably only just getting to that cash flow position that we need to be at. And I assumed that would have happened a lot sooner because I naively underestimated just how much front loading. And mentally as well, that takes a big toll on your drive, because you need to be focused and keep that momentum and keep that enthusiasm. And when you've spent 9 to 12 months, if not longer, and you're not really seeing any direct results from that, it can be quite hard or quite easy to become disheartened. So that's definitely been a challenge with regards to the exit, is how to stay motivated, to stay focused, and to keep your eye on the end game. Because you go from running a business which is already up and running, it's cash flowing, it's working, stressful, but it's working, to chucking all your time and money in, and it's still not cash flowing yet, and you've got various different projects to refinance and different variables that can change throughout the process, like the refurb costs and lending's going up, utilities. There's a lot of pressure that people don't see on property investing. Everyone just assumes you can just buy a house, rent it out, get done. It's those that do it full time and execute BRR strategies and that are actively seeking angel investment and growing a portfolio, got a newfound respect for them, having spent 2 years doing it, without a doubt.
I think you talked about that risk and an emotional risk as well, and I totally agree. And when I look at a number of the people that we know together that are incredibly successful, and I'm sure many people that we follow that run great successful companies as well, that risk thing is, I think, often a common factor. Very few people have achieved great things without taking those risks, and actually that on a granular level. For you, like you said, you had a newborn on the way. You built your baby. This business, it's so emotionally invested in it, and you had to sever your a big part. Well, your package, your salary, and take this huge punt on doing this. But I think it's the ability to do that, and like you said, make those calculated decisions, and understand and assess those risks. That I think differentiates a lot of people who are successful, in property, but also other businesses as well. And you're definitely someone that I've seen, consistently look at opportunities that have come your way, consider, the viability of them, and make, really logic-based decision about whether or not it's the right thing for you to invest your time in. And I know that the properties and buying the HMOs has just been a part of it, albeit the larger part of your strategy, but there's been other bits that you've also been doing on the edge, and I'm quite interested to talk about that as well. But just going back, if memory serves me right, Adam, I think that the package, the deal that you were going to strike with as part of your exit, meant that you weren't going to get everything at once. There was going to be a delay, and that's very normal in business, isn't it? So actually, what it meant was that you weren't just going to be able to walk away from your business with a huge stack full of cash to buy all the properties that you want. You had to work really, really hard to exit, and then very quickly build up that cash flow to get you back to where you were when you left the business. And I remember we laboured a long time on this, didn't we? Figuring out, okay, how are we going to do it? What types of properties? Where are these properties going to be? Do you remember that process that we went through?
Yeah, definitely. I think that so going back to the calculated risk part, I think there are two sides to it. So you've obviously got the mental leap of faith, which is actually doing it, and then you've got the actual risk portion, and I think you can manage that risk quite easily. So for me, the process of leaving was very much like what runway do I need? How do you build that runway? And I think anyone that's employed as well that wants to go into property, and I've spoken to a few people about this over the last couple of years, And my advice to them has always been, well, how long do you need to make it work? If you need 6 months, then work on saving 6 months worth of living costs.
Is that
And then
what
you
you did,
know,
Adam? Did you put yourself a runway of about 6 months?
yeah, I guess because my exit, originally the plan was, in an ideal world, big lump sum, walk away, move on and start investing. The reality was it was a 2-year earn out, which was paid quarterly, which equated to my monthly salary. So in reality, what that meant is I had 2 years runway um, of time to get this business up and running, but I didn't have a big pot of capital. I didn't have anything to work
Which is
with.
a problem
I didn't
when you're going to invest in property.
Yeah, exactly. I didn't even have, any kind of emotional funding. So it's not like my parents had a big pot of money that they could lend me. I didn't have any of that. So we had to really think about how we were going to get the business up and running. So yeah, I knew I'd got a 2-year runway to start the business and to scale it. And anyone that's leaving a role or a salary, again, my advice would be to kind of get that runway in place, so you know how long you've got. Then you give it a go, and worst case is you can go back. So my view is I've got 2 years to make it happen. If at the end of 2 years I can always do consultancy, or I could go back to kind of a non-exec role or something else within that digital space. But I wanted to avoid that at all costs. So for me personally, I'd got 2 years worth of salary, no pot of money. So we had to take quite a big decision to refinance our own family home, which to anyone that's uneducated in good debt and bad debt, the opinion for most people is that that's very risky, and you shouldn't leverage your own property. You should try and clear your mortgage and live mortgage free. But the more I started to embark on, I guess, the educational piece around property, the more I realised actually I just need to control this asset. I don't need to live in it. I've got equity tied up. In reality, if I we ended up taking out 80k from our own home. That cost me, say, another £300 a month. But I knew that I could service that debt with the rental income from the properties I would buy. So for me, it wasn't a big risk. And at the same time, I'm going to get capital growth on 2 properties, because I'm not going to get it on my own home. I'm going to get it on the investment property that I go on to buy. So we did the maths and we figured out that the only real way of getting it started was to take out some equity. Some people are lucky enough to raise angel investment from day one for the full amount. But from my experience, I think most angel investors want to see some degree of track record or some skin in the game. So we decided to take the money out. That was the deposit and stamp duty for the property we purchased. And then we set about raising the angel investment for the refurb. And that's how we structured our first deal and got off the ground. So it was very much pulling equity out, and we were very fortunate that someone I used to work with was willing to back me, because he'd worked with me before, back me and loan me the money to cover the refurb costs of the first project.
I really appreciate honesty, Adam, because I think that this sort of context is so important. It's so easy to look through the window of Instagram and listen to the headliner of maybe your story, which is, exited, a digital business that you grew. Great. Adam probably walked away with, a huge sack full of cash and was able to go and buy loads of properties. And actually, you had to build yourself a 2-year runway. You had to refinance your own home. And then you had to work, as we're going to find out, I'm sure, incredibly hard to actually then make it all work. And I think a lot of people will listen to that and think, oh, shit, actually, that is what it takes. And that is what it takes. It's very difficult just to walk in to this game and buy property unless you do have lots and lots of money sitting around, which, in all honesty, very few people do. So I do appreciate your honesty, Adam. And I think as well, it becomes really clear when we listen to that story and how you've structured, certainly buying the first one and borrowing the private finance to do the refurb, then why the deal and the project that we're going to talk about today, your case study, is such a good example of being able to recycle cash. And I think there's a few things that you did with this deal that beautifully highlight how to successfully recycle cash out of a deal. But before we get on to the case study, Can you talk me through the process of actually bringing in that finance? There was somebody that you knew, there was the trust element there, perhaps. On a very sort of practical level, how did you actually do it? Was there a loan agreement? What sort of terms did you agree? What sort of rates? What contingencies were in place?
Yeah, so obviously I was full time, effectively full time in property from late 2020. We were looking for deals, and as you know, as you said before, we'd actually found one that stacked up. We started to go down that road, and turned out actually it wasn't a viable investment, so we had to walk away from that one halfway through conveyancing. Found another one, and during that time I was constantly kind of messaging people on LinkedIn, emailing people, social media, anyone that I knew, just saying that
You were
I
that guy, Adam.
yeah, yeah,
My
basically, yeah.
LinkedIn inbox.
Yeah, everyone. Telling everyone about what I was doing, saying that obviously I'm looking to raise some angel investment. So in the end, an ex-colleague came forwards. We structured it via a standard loan agreement. So it was a 12-month loan. We gave him 10% return. I think the return aspect is something that is also perhaps not discussed very often, because we hear about people raising investment at 7 or 8%, but in reality, when you're starting out, you're an unknown quantity, and you can't expect, in my opinion, to raise angel investment without any track record, like at 6 or 7%. I'm sure people do, but I think being realistic, my view was I need the money. I'll factor it into the deal up front. So when I run my numbers on an appraisal, I'll factor in what I'm borrowing and what the interest is going to be. So it doesn't, if it's 12% or even 15%, if that's what I'd gone in at, it wouldn't have made much of a difference, because I'd already ran my deal with that baked in from the beginning. But we gave him a 10% return. It was a 12-month term in total. I think he loaned in, I think 50k. We still had to find more money to top up the refurb because the costs went over. But yeah, basically that was how we structured it. Standard loan agreement. There wasn't any personal guarantee. We did look at that, but when you start going into the legal costs of drawing up personal guarantees, independent legal advice, you're going to sink 3 to 5k potentially into legal fees. If it's a 50k loan at 10%, it's a 5k return for him on top of his money. Even if we go half on it, we're eroding the benefit to him loaning the money in the first place. So he was quite relaxed and happy to work on just a loan agreement, and that worked out for us. I mean, I value my integrity, my ethics kind of very highly, so we were on the same wavelength there, and I always knew he was going to get his money back regardless, even if the project went south. Luckily, we've got some buy-to-lets, so there was a degree of security there from his point of view that we have some assets. We don't want to sell them, but if we needed to, we'd find a way of paying that money back.
It's actually very simple, isn't it? And you know me, I actually love simplicity in business. Buy the building, borrow the cash to do the refurb. Don't secure the cash against the asset, but maybe whether you did or didn't, I'm not sure. But in essence, what you described as you were more or less personally guaranteeing the money, weren't you? Because you would have given it back no matter what, and just do it on a fixed rate basis. And it's really easy to get in and get out of that deal, and it gives you the flexibility. Did you say you did it over 12 months, Adam?
Yeah. So it was a 12-month loan, and the loan was into Highline property. So at the moment today, all of our angel investments work the same, in that investors loan money into our limited company, which holds our assets. And we then use that as working capital to invest into our SPVs or into our properties. The reason for that is it gives our investors a degree of security around the fact that we've got assets in our company. So if the worst happens and they came after us, there's something to go after. If they're investing straight into the SPV, our concern was the lender's going to have the first charge. Yeah, they may get a second charge, but if the money is used for the refurb and you're halfway through the refurb and it went south, the property is not worth the GDV, and they're going to be left without any recourse. So we structure our investments in that way deliberately now. So we basically borrow working capital and repay that working capital in its simplest form. That's how we operate.
So this project, the first one that you bought, it was part of a grander plan, wasn't it? And I remember talking about using this as almost a way to prove the concept
Yeah.
and also start building the brand. And I think you did a great job of this. This is something that I talk to a lot of people about, and raising finance, I think, for so many people is a key objective. Even if you have the capital for the first one or the second one, ultimately, nearly everybody's going to run out of capital. There's not enough to continue to buy. So that's got to come from somewhere. The banks, privately, wherever it might be, and building a brand and that, I suppose, public credibility, I think, is really important for someone who recognizes that raising finance is going to be a key part of how they actually build a business. And you identified this off the bat, and I remember this, and I remember the time and thought and work that you put into Highline and what you did with the first project as well. Can you talk to us about that and where that sat on your list of priorities and how you actually managed to do this? Because I know, and we're going to talk about it, that you've gone on to raise more finance, and that's what's helped you do subsequent deals as well. But am I right in thinking that that was a key part of your methodology in this first project, Adam?
Yeah, yeah, it definitely was. I think it was always front and center of what we were doing, that we would need to showcase what we were doing very publicly in order to increase our credibility and raise further investment. So we were on, I was on social media, which actually is quite, it pushes you out of your comfort zone. I mean, being on stories, doing Instagram live, it's something that is, for me, was a real challenge because I'd never had to be publicly facing before. I was always very much a very kind of operations kind of director within the business, not really front and center. So yeah, we had to be very transparent with what we were doing deliberately, because my view is that's how I'm going to go on to raise additional investment, is people seeing that I'm doing it and that we're sharing it in its rawest form. I operate on transparency with all of our other investors as well. We do site visits; they can come and see our properties, and I've always been quite keen on that concept of being really transparent across everything, really, because especially with property, it's a very weird sector that everyone's happy to share and help each other. There's no way I could grow the agency and put myself out there and share the figures and the numbers on our business and have other agencies collaborate, pat me on
Yeah,
the back. They'd be literally ripping you apart, trying to steal as much as they
it's
can.
true.
So property is really, really weird in that respect. It's probably the only industry I've ever known or been exposed to where you can post on social media, and I can be creating a high-end HMO in Norwich, and arguably I am competing with other people, but those other people don't take it upon themselves to necessarily steal what you're doing and take it themselves. They support you, and in return you support them. So it's a bizarre industry, but yeah. But going back to the marketing though, yeah. So yeah, for the fundraising, for me, it was all about being transparent, showing what we're doing, and just working in good faith that would kind of come back to pay us.
You said that didn't come naturally to you, and I get that. And actually, I'm not sure if people believe me when I say this, but it's the same for me. Now, I would probably, in all honesty, be much more comfortable not being, on a camera on a screen. But I realised the importance of it for my business at an early stage, and I just, as there are bits and pieces. I don't dislike it, and I've certainly grown to be more comfortable with it, and maybe even enjoy it. But it's certainly early on that wasn't the case. But did you really have to push yourself out of your comfort zone? Not just to actually to do it and get behind the camera, but to also find time to prioritize it. Because I don't know about you, one of the things I often see and feel is when we're on social media, we can spend a lot of time on social media creating content, planning content. It can feel like a bit of a waste of time, because the results aren't instant. As we'd love to think they are. We love that instant gratification of a like, but it doesn't necessarily mean that it's not like £1,000 dropping into our bank account every time we get a like. And that's a challenge for people, and particularly when you're already under pressure. You've talked to us about that. There was a certain degree of pressure for you. You had to make this work. You had 2 years. Was that something that you were conscious of?
Yeah, yeah, definitely. I think I, I think it's either yourself or someone on the mastermind had made it very clear that you don't know who's watching,
Mm,
and that's a very key takeaway for me from that mastermind was you never know who's watching, and just because you don't get the likes, quite often someone can be sitting there in the background and they're reviewing what you're doing, and they're not going to come forwards and like or comment or message you. They're just kind of looking at who's about, seeing what everyone's doing, and as and when the time's right for them, they will come forwards and potentially step
mm,
up. And we've had that already with our subsequent funding. Is people that have been following us for a year and they've never messaged
hmm
us, they've never liked a post, they've never contacted us, but I can see they've been following me and they come forwards. So yeah, it is really hard to continue with the social media marketing and continue with putting posts out and stories out in good faith that it will pay dividends later. Because yeah, especially with social media, it's very hard to become um, yeah, just disillusioned and disappointed by the results, because I can put a post out and you can get 15 likes and you think, well, is that it? Is it just 15 people that like
Yeah.
this new bathroom I've done? In reality, people have seen it. They're not engaging in the same way that you want them to. You can't, I learned fairly quickly, you can't measure everything by the number of
Yeah.
likes. The value is actually by just giving people exposure to what you're doing, and sure enough, they will come forwards eventually if you're adding value and you're showing that you know what you're talking about, and your morals are in the right place, and you're investing and you're doing it. It definitely pays off
I think
eventually.
that is such a good takeaway, Adam. I completely agree. And we call them lurkers. There's lots of lurkers out there. But it's true.
Yeah,
And we found the same over the years. And I found the same over the years. And people who've said they've been literally following stuff for years, never reached out, never said anything, never even as much, said hello. And then at some point in time, when it's right for them, they're looking for an opportunity. I've got a bit of cash actually. Is there a way of working together, or just doing something great? And I think that is the best thing about social media, because you've put all of that hard work in being transparent and letting people see through the window and have a peek at what you're doing and how you do it, and you naturally attract people who like that, and anyone who doesn't will probably go and look at other stuff. But over time, you've I suppose on a very subconscious level, already built this relationship with somebody, which means that conversations about working together and finance are much easier. There's much less friction in, and I just don't think you can put a value on that. But you've got to be, and I say this to everybody, and I know this is something we talked about many times at Mastermind, is consistent. It's if you're not consistent, people's attention goes elsewhere. And I think that's the thing to be mindful of. It doesn't have to be expert content either. It doesn't have to be super fancy, expensive reels. You don't need sort of, a 50-meter screen in the back, looking like you're, at the news studios. You just need to pick up the phone and tell people what you're up to today. And I think that
yeah,
very real element is the easiest way to create content. You've done a great job of that. And I remember on your first project, you were often concerned that you didn't maybe have enough content to talk about. And I remember saying, just get on site and show people what you're currently doing, because people will enjoy that. I said, I enjoy watching that, even though I've done it, dozens and dozens of times. I still enjoy watching people go in on their properties and walk us around and show us, the stuff that's going on and the cool stuff that they're trying and the stuff that hasn't gone well. And you did a really good job of that. And I think it's really interesting just to see that how conscious you were of this and how important that has become, which I think is a nice segue into telling us where things. We're going to come back to to your first project, but tell us where things have gone and what that sort of first project and that, I suppose, that first 9-12 months have enabled you to move on to, Adam.
yeah. So we financed the first one, and when you're first starting out, you don't really build a pipeline because you don't want to buy something until you've got the money in the bank. And by the time the money's in the bank and you buy something, you've got to wait for conveyancing. So there's definitely a lag there for me between finishing our first one and buying the second one. So the angel investor for the first one actually came forwards and said, got no plans for the money. I'd like to go again, but I want equity. So given that I originally didn't want to really JV with too many people, and I still don't, But given he'd backed me in the first instance and no one else had, I felt it was fair to JV with him. So I'd been looking for properties anyway. The Magdalen Road, which is the one we're doing at the moment, that's coming to an end now. But we put an offer in on that. That was, I think, even that was 5k under asking, which was silly money compared to what the actual value was. I think the true value of the property is 250. We secured it for 225. It was on for 230. And I know the actual value is 250 because if you look at the price per square foot and the size of the property, just on that alone, it was valuing up at 245. So we knew immediately we'd got a good deal there. But I still remember finishing our first project and having the offer accepted. And I kid you not, I nearly rang the agent back and said to him, no, actually don't put it forwards. I'm going to step away, because we hadn't got the money in the bank yet from the refinance. And I was panicking in case I couldn't raise the money, even though I'd done it once before. But in the end, I just sat on my hands, and the angel investment came back, or the angel investor came back, wanted to JV with me on it. So I used his funds. We then got some additional angel investment on top of that, and I put some money in as well. And then we got to the second one. So that started to go through conveyancing. And at the same time, I was working really closely with Matt at AM Living in Norwich. So he manages my HMO.
Matt's been on the show actually, hasn't he?
Yeah. He's an incredible investor, and he's an incredible HMO manager.
He's a good skier as well.
Well, apparently so. I don't ski, but he definitely he's on the dry slopes quite a lot in Norwich. So I got talking to him, and actually a really small unit came up for sale in Norwich that was on for, I think, for 130. I'd looked at it and immediately thought it was perfect for a service accommodation. He'd looked at it and thought about using it as an office, completely overlooked the service accommodation aspect. So we had a chat. He was interested, so was I. It was a relatively low purchase price, so we decided to go in together and joint venture that one. So we purchased that at 113 or 117. So again, it was on for 130. We got it for 117. This is still in a red hot market as well, and that's because it's a commercial conversion. The people that tried to buy it before, they didn't know what they were doing. They'd walked away from it. The vendor was then more motivated. So we secured that one, started to go through the process of that one. And then about 6 months ago, another one came onto the market, which was a multi-unit. So really, really big property near the train station in Norwich. That one, we knew immediately that it was worth a lot more than it was listed for. So GDV, based on just square footage alone, is around 400k. It was listed for offers around 310. So we immediately knew there was some headroom there for that deal. It turns out that the previous owner had purchased it. She'd split it into 2 flats, but she hadn't done a title split. So from a lending point of view, it meant that you couldn't, as a standard residential buyer, you couldn't buy it because it had 2 kitchens. It was set up for 2 apartments. So a standard, basically homeowners were just off the table. Investors were struggling as well, because you need a multi-unit product. Someone had tried before and failed, so hence the price had come down to around 310. Matt had experience in this before. We used a bridge to buy it. Obviously, bridging is slightly more expensive, but you don't run anywhere near the same due diligence on the property and the rental income that you would with a standard mortgage. So we bought that on a bridge, and we're currently refurbing and refinancing that one at the moment. So that's the run of things. It's been the first HMO with a 50-50 JV. I've got 2 more with Matt at the moment, which we're doing now. And we've got one really big one in conveyancing, which we're about 200 square metre property, which is going to be 2 4-bed HMOs, which we're currently speaking to funding partners about. So that's how it's progressed. So we're now building momentum, and I'm looking to get these previous 3 done in the next couple of months. We've then got the one big one to focus on, and then we'll be looking at while that one's going on, we'll be looking at what comes next. I've done a lot of cash flow forecasting for the business, so looking at when we've got funds returned, when we're going to be short on funds, when we need to raise angel investment. And that's a really big thing as well. I think, and so many people I speak to don't have a handle on the cash flow forecasting, and it's so important. If you're trying to build momentum, you need to know when your refinances are happening, how much is coming out of each deal, how much you're going to roll over into the next deal, what the refurb costs are, when are you forecasting those over the next 3 to 6 months, so that you can confidently build momentum. And I guess, as I said before, I nearly pulled out that first deal because I didn't know if I could raise the money. And for me, having that cash flow forecast gives me more confidence around what's my worst case. Okay, I need to raise another 50k before September, so I'll make sure I make that a priority now to ensure that it happens. So that's kind of where we've gone to since the first project, and kind of running those JVs has been really really good, because I've been able to have more exposure to more properties and gain more experience quicker. Obviously, you take less home, but actually you spread the risk at the same time.
Well, I was going to ask as well. You've obviously picked up a lot of momentum, and you said yourself the first project took 9 months. It felt slow, and then you've gradually picked up pace. You've started to work with other people. You're using more and more private finance. What's allowed you to bring more deals on, Adam? It's certainly not that the market has got more attractive. Is it a confidence thing? Is it a skill thing? Is it knowing more people? Or is it all of it?
I mean, it's a combination of all of them, really. I mean, confidence is a big one. Being able to offer on a property and have the confidence that you could find the money from somewhere. And we're still obviously fundraising for this current project, and there's always an element of concern that you're not going to raise the money. So that's always in the background for me. Until the money's in the bank, it's there's still quite a bit of risk. But the confidence is a big one, kind of actually making the offers, having the credibility to make the offers and get them accepted. Another big part for me has been being able to secure the properties at such a good price. And that comes to just being really good with your own due diligence and knowing the market, knowing what something's worth, and appraising that. Obviously, as you said, we've worked on the deal stacker, which is part of the HMO roadmap. That I use that tool very, very regularly. In fact, I appraise everything on it to ensure that I can stack my deals up, and I've got a very systemized way of stacking deals and offering on things. And the biggest thing for me is not just having one deal. You've got to have 5 or 6 properties you'd happily buy when you're looking to buy, so you can offer on all of them, because then you can afford to leave them on the table. And that for me is how I operate my business, is by stacking up as many as I can, figuring out at which point does it work for me. That's what I offer on, and those offers go in and I sit on them. And with the big one we're securing at the moment, it was originally on the market for 550,000. We secured it for 355 in the hottest market I think we've seen in years. That took 9 months to negotiate, but that just came through just consistency with the agent, knowing what it was worth, and just sticking to our guns, because we didn't need to buy it. So we could just afford to leave the deal on the table and keep following up with them. I think when we first put it in, they laughed at us, and then ironically it came down to, I think, 400, and we were at 355. So immediately it was only 45.
Who's laughing now? I think that's actually sometimes you've got to be prepared to put in an offer that you might get laughed at for. It's happened to me before. Just because agents put a price tag on something, or even sellers and vendors, does not mean that that's what it's worth. That is not the value. That is the asking price.
Yeah, definitely. I think that knowing your numbers helps with that. If you know what it's worth, and if you're aware of the price per square foot, and you know the size, and you know the local stock, and you can be confident on the value, then you can go in with a low offer, because you're not lowballing them. For me, I don't believe that I put silly offers in. I don't go to agents if it's on for 300 and offer them 2 just because I can. I do my research and my due diligence, and I figure out what I think that asset is truly worth. And then I'll figure out what numbers work for me. Where does it need to be for me? And then my offering range will start perhaps 10, 15% below where I want it to be. So I've got some room to move. And I'm very calculated with the way I offer on properties. But yeah, I think there's this kind of stigma around agents, won't like low offers. But at the end of the day, if it's been on the market for 4 months and no one's buying it, there's a reason for that. It's on for too much money. So actually, you've almost got to realise what the asset's worth in the first instance in order to make your offer, and know what it's truly worth. Otherwise, you're kind of just gambling, really.
I remember when you first came to a bit of work with me 3 years ago, and I remember thinking very clearly, Adam's going to go on and do great things because you had um, a way of looking at problems, assessing the solutions, and then really focusing in on what you needed to do to actually make that happen, where your efforts and your time needed to be spent. We've touched a bit on the social media bit, and you invested in that part of your business, and it's paid dividend. You invested in really getting very good at appraising and analyzing deals, and being that expert in that subject, and also locally. And I think you got very good at going out and finding the money. But before we sat down and hit record, you said, I've just come back from holiday. I've just come back from 4 meetings that I've arranged because we need a bit of finance for the next project. You'd arranged 4 meetings with investors as soon as you got back, and I think that says a huge amount about an investor, or somebody like yourself or ourselves, because that's where you place the priority. That's where you put the priority. It's actually going out and finding that money, because without that the deal's not going to happen. And I think a lot of people struggle with that. I think a lot of people procrastinate around those ideas, and sometimes it isn't easy to pick up the phone and try and get people and investors sat down, have a coffee. And sometimes, like you described, looking for properties, having that pipeline will. It can be the same with investors as well. You have a few investors that are interested in working with you, because one of them might change their mind, or one of them might be uncontactable or on holiday just when you happen to need the money, or the investment that you've been talking about. So it's I think it's really interesting to hear you talk about that, and I'm pulling all these bits and saying, I can see that that's why Adam has been able to make this work so successfully. Let's circle back around and talk about this deal, your first project, because it really is a cracker. And I remember being so pleased for you at the time, because how long did you, well, I don't want to say wait, but how long had you been looking at stuff and appraising and analysing and viewing and offering before you actually secured this one?
It was probably at least 6 months. And the thing
Six
is, it
months.
might be 9, because in reality, what happened was we started looking. We found what we thought was a great property. We were going to do a garage conversion. It was going to be a 5-bed. The area was fairly good. It was going to be a 5-bed. And we went through conveyancing, had a few build teams out, and it then transpired that actually the cost to renovate, the cost to transform the garage, just due to the way the building was structured, was just non-viable. So we had to make a decision then to walk away from that. I never like walking away from an offer that we've put down, because I don't like to mess people around. I'm not in the business of putting offers in and pulling them or reducing them. But we had to be really realistic, and it didn't work for us. We had to walk away. So start from scratch. So we spent 2 months going through the process of finding that one, going through conveyancing, only to walk away, start again. I then reviewed what was on the market, and we'd identified, I think, 4 properties at that point that worked for us. So knowing that we'd got 4 potential deals, I'd run the numbers on them, and we'd figured out where we needed to be on all of them. And I deliberately went in lower than I felt comfortable with all of them, knowing that I've got 4 on the table. So I've got a 1 in 4 chance that if 3 of them reject me, 1 may accept. So the property we ended up purchasing was on for 250. I went to view it. It was a bit of a state. The agent let slip they were divorcing, which is a big no-no if I'm negotiating. So we put our offer in at, I think, 217,000. The agent immediately came back saying, not a chance, not going to have that. So left it. About a week later, he rang me, tried to get me to increase, told him we weren't going to increase. Ironically, a property of a similar size had been sold about a month earlier for 210, but they're not like for like comparables. So when he rang me the 3rd time, I basically said to him that we were going to pull the offer, because actually we think we've offered too much. The one down the road sold for 210. We're going to take our offer off the table. We're going to leave it a month. If it's still in the market, we may re-offer then. And within half an hour, he rang me back and told me that they'll accept my offer. So we played pretty hardball on that first one, but we secured it for 217. So we immediately knew we had some equity to play with on the refinance, because we'd secured it at a good price.
So it was marketed at 250, did you say?
Yeah, yeah,
And you got it for 217.
yeah,
That is just such a good. I think that's a great example of two things. First of all, um, vendor-led pricing, I suspect.
yeah.
But also, I think I'm not sure what the word I'm looking for is, but for you to be able to resist the urge to increase your offer at any number of those points where the agent was prompting you and letting you believe that it was probably yours if you maybe just offer a little bit more. I mean, to be able to do that takes some doing, because emotion would get the better of most people, in all honesty. And I think, again, it just shows the degree of focus, because you were so clear that actually this deal worked at this level. The numbers work. I can recycle the capital that I need. The property and the pound per square footage, it all works at this level. It doesn't work at a pound above that. And I think that is just, it's such a superb lesson for anybody listening to today's episode.
I mean, we were quite lucky. We were governed by our own budget as well. So to some extent, I couldn't afford to offer more because we didn't have any more money. So, I mean, we would have found it if we needed it, but that helped me hold my nerve when it came to those negotiations, because I'd run the numbers and I knew on each of those four what I needed to buy for with our budget on the refurb to get it to work. But even the purchase was painful because we ended up with our broker, which was our previous residential broker. He'd suggested we use a lender that ended up taking 2 months, didn't even get to come out to do a valuation on it. The buyer then potentially was going to pull out if we didn't purchase soon, so we had to switch to a bridge. So within 2 weeks, I changed to a different broker. I still use her now. She's amazing. She does all of my lending, but she puts on a bridge. Within 2 weeks, we'd had our offer from the lender, so we were able to purchase it on a bridge instead, and then we then went through the painful process of refurbing the property, which was,
and it was a big refurb, 110,000. You extended it to the side, didn't you? I remember you made the kitchen and living room. You got the extra bedroom.
yeah. So it was a standard kind of, I guess, 1930s semi, with a large lounge, kind of dining room, kitchen to the left. So we did a side extension, which allowed us to use the kitchen and the side extension as a communal area. We added in a ground floor bathroom there as well, so we've got one communal bathroom. We then split the living room and dining room into two to give us the 2 bedrooms downstairs. Those 2 bedrooms share that one bathroom. And then coming upstairs, we had the main bathroom, which was basically completely overhauled and redone. That services one of the bedrooms, and we added 2 en suites upstairs. So we've effectively got 2 off suites, 1 off suite, and then 2 sharing one downstairs, which means that we've got, if a shower goes wrong or something goes wrong, we've always got that communal one downstairs that anyone can use. And at the same time, we've got, Norwich is very much bricks and mortar. We don't get commercial valuations. So for me, everything we do has to stack up as a family home. So we had to look at how can we make this a good residential asset that we can crystallize overnight if we needed to. Going all en suite in this particular postcode would never have done that. So we had to very much keep it configured that we could easily revert it back within a day to a residential home, in order to resale it if we needed.
Well, and looking at the numbers, and I'm looking at the numbers now, and of course, this is all going to be inside the roadmap, your case study, but it nets after your costs, after your mortgage, your maintenance costs, your management, nearly £19,000 a year, so about £1,600 a month, which is amazing, really. That's a part-time salary, and you did it in one deal. And to get into the deal, your deposit was 65 grand. Your refurb was 110, almost twice as much as your deposit. So you were all in for just under 200 grand. So we said it before, didn't you? You need a lot of money to get into this sort of stuff. But, and I think this is where it starts to, really look special. You recycled 60% of the funds through the deal. You ended up leaving about 75 grand in the deal, 10.5% gross yield. You return on the capital left in the deal, 25%. And it cash flows £1,600. That, for me, is a great deal every single day of the week. And the spec, and it's difficult to convey that on the podcast, but for all of our listeners, go and look at Adam's project. I'm actually about to pinch one of your ideas. No, borrow. We don't pinch. We're property investors. I'm going to borrow one of yours. I love the textured paint that you used,
Yeah,
and I want to really try that in a project I'm doing at the minute. But it's a superb deal, and I think it just, everything that we've talked about in today's episode, we can see in there the way that you managed the actual purchase and the price that you agreed, the type of property that you created, the spec and the look of it and the design, and how you use that for social media to help you raise funding for subsequent projects. I think it's a brilliant example, and one that I think, I don't want to say it without the context of what's involved in a refurb, but I think that this is someone that everybody can replicate, if they know how and apply the same degree of diligence. We're probably running out of time to talk about some of the difficulties that you had on your refurb, and I know that there were quite a few.
yeah.
But Adam, for everyone listening today, we've talked and we've touched on some really great stuff, and I'm sure a lot of stuff that our listeners can take away and actually, put to good work in their own businesses. But if there's one piece of advice that you were going to offer to our listeners about investing in HMOs who want to maybe do what you're doing or what you've done, what would it be?
I think it's probably consistency. It's being consistent, like social media, with the funding, with all of our funding lines, with the deal stacking. Obviously, we've got a process that we follow. It is just consistency. I think it's that's seems to be the single thing that makes the biggest difference. From other businesses I've seen, the biggest thing that makes the difference is consistency. I think you've just got to know what you want, go for it, and just be consistent until you get there.
Before we wrap up, you're working on some pretty exciting things. Are you allowed to give us like a little bit of an insight or an inkling into what they are?
Yeah, sure. So the property for us was always we're going to continue to grow it over the next probably 10, 20 years, but it was always a means to gain cash flow to free up our time. So the tech side of things is quite interesting. So I'm currently working with JP, who's your non-exec, on a quite cool kind of tech business that we're now about to go for seed funding on. So we're looking to raise some seed funding to get that off the ground. So hopefully, moving forwards, I can allocate a portion of my week to tech startups. With my digital background, that's where I want to be long term. So the property portfolio is something I love, I really enjoy, and that gives us the cash flow. But alongside that, we're looking to kind of run an alternative business, which will be in the tech space.
I'm smiling because I'm thinking to myself, when we get you back on, at the end of chapter 2, whenever that might be, maybe in a year or two's time, I think you're going to be on the back of your yacht recording that one.
Perhaps let's do being to Adam myself. But yeah, I mean, hopefully. I mean, there's still a long road to go for us. So obviously, with our current properties, with where the portfolio needs to be to give us the cash flow, and the tech startups, it's still very much in its infancy. And it's felt like we've been almost at that tipping point for the last year, and we haven't tipped over yet. So we'll keep kind of being consistent and following through with everything, and hopefully in 12 to 24 months we'll start kind of yielding some results.
Adam, it's been great to get you on the show. It's been great just to have a good old catch up anyway, as we often do. I feel like there's so much we're leaving on the table today, though. We haven't talked about some of the more challenging stuff, which maybe we should get you back and do. We haven't talked about things like masterminds, which I know being part of the mastermind was an important part of helping you do this, and the network, and actually that's where you met Matt, wasn't it? So maybe there's another episode in before we get you back to talk about the end of chapter 2 anyway. But I know, thanks for coming on the show, Adam. It's a great story. I'm so pleased. I feel a little bit proud in the least patronizing way possible. Actually really proud to see what you've been able to do and achieve, because I know how hard you've worked. I know the pressures that you've been under. I know that you put yourself under a lot of pressure, actually. And it's just, it's really great to see you doing it, and doing it so well.
Cool, appreciate that. Yeah, well, obviously, thanks for having me on, and look forward to coming back.
For anyone who's listening or lurking who's thinking, you know what, Adam's doing some cool stuff. Is there a way that I might be able to work with him or maybe invest with him? How do they contact you?
Yeah, predominantly Instagram.
Yeah.
I'd say Instagram's my main channel I use. So it's just at Highline Property. Yeah, I'm normally kind of lurking myself, seeing what other people are doing. So if anyone wants to either reach out, DM, if they're local to me, perhaps have a coffee. Yeah, always happy to meet people.
At Highline. So if you're lurking in the background, but you've got a bit of cash, or maybe you're just interested in what Adam is doing, come out of the shadows. Come and have a chat to Adam, and yeah, I'm sure you won't regret it. Adam, thank you so much. Been an absolute pleasure. Already looking forward to getting you back on the show next time, and I can't wait to see what you get up to in the second part of this year.
Cool. Cheers, Andy.